Korea's central bank has not touched its policy rate in over a year, yet the rate on a new mortgage just climbed half a percentage point. Today's top story isn't just a banking story, it's a signal about who pays when regulators squeeze credit. New mortgage rates hit 4.36% in June, and unsecured loans 5.72%, both up roughly half a point in 13 months. Large corporations barely felt it. Their borrowing costs rose just 0.02 points, and households are moving money out of low-cost bank accounts at the fastest clip in 5 years. It's Monday, August 10th. Let's get into one of Korea's top economic stories today. The Bank of Korea cut its base rate from 2.75 to 2.5% in May last year and has held it there through July. Over the same stretch, financial authorities capped new mortgages at 600 million won, about $430,000, and added tighter limits on costlier homes as global yields climbed. Banks squeezed between rising funding costs and hard lending quotas reach for the one lever left: price. Here's what the numbers show. Average rates on new mortgages reached 4.36% in June, up from 3.87% in May last year. Unsecured consumer loans climbed from 5.21 to 5.72% over the same period, while small business loan rates added 0.21 points to 4.38%. Large company rates edged from 4.15 to 4.17%, up just 0.02 points. The U.S. 10-year Treasury yield touched 4.74% in late July and stood at 4.65% on August 7th, while Japan's 10-year climbed into the 2.7% range. Household loans at the five major banks reached 650.4 trillion won, about $462 billion, as of August 6th, up 5.4 trillion won, or $3.8 billion this year. That increase already exceeds the bank's combined full-year growth cap of 4.33 trillion won, roughly $3.1 billion. Banks responded by blocking online mortgage channels, cutting overdraft limits to 50 million won, around $35,500, and raising rates. Demand deposits at those same banks fell below 30% of total deposits in July, a 5-year low, as 56.4 trillion won, about $40 billion, drained out in a single month. So what does this mean for anyone following Korea's economy? Earlier, we said large corporations barely felt this, while household borrowing costs jumped half a point. Here's what that actually means for you. The cost of Korea's credit crackdown is landing on households and small businesses, because banks are pricing loans to stay under government quotas, so a frozen policy rate offers borrowers no relief. With deposits migrating toward time accounts and loan growth capped, tighter access and higher prices look set to define household finance through the second half. 3 things to watch. 1. The U.S. 10-year yield around the 4.7% line. Another leg higher feeds straight into Korean loan pricing. 2. July household lending and deposit figures, with the 5-bank loan balance already more than 1 trillion won, about $710 million, past this year's cap. 3. Whether the Bank of Korea, on hold at 2.5% since May last year, addresses the gap between its policy rate and what borrowers pay. That's today's AI Prism Front Page Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a Won IFRA award-winning series. We'll be back tomorrow.